Hi, you're watching MC Explains, an investor education initiative brought to you by Moneycontrol and Invesco Mutual Fund. I'm Sumera Abdi. Today, let's talk about the principles of asset allocation. Asset allocation, as the term suggests, allocates the investor's money across different asset classes. This is essentially done to find the most effective or efficient combination which can help you reach your goals or objectives without undue stress. Now, you'd wonder that even ordinarily, you would have invested in more than one asset class anyway. So what's the big deal? The big deal is that you may have invested without any rationale. Proper asset allocation must follow the steps of the process, neither of which can be ignored or skipped. For example, it must begin with quantifying your goal and tenure and mapping it to your risk profile, dividing that investable sum into asset classes, and within that asset class, what is the breakup between products, as well as deciding how this subsequent portfolio will be maintained or reviewed. Skipping even one of these steps can prove costly. Now, there are two popular asset allocation approaches which are adopted by investors: strategic and tactical. So let's start with strategic asset allocation. This is allocation aligned to the financial goals of a person. Under strategic asset allocation, you will need to specify the goal or the objective, how much money you require to achieve that goal, how much time do you have in hand to do this. And from here, you'll have to work backwards to calculate the amount of money you will have to invest to reach that goal. Once you have this number in hand, you will need to allocate it between the different asset classes to optimize your journey. And here is where you need to ask yourself, what is your risk profile? If you have a high risk tolerance, you may consider being overweight equities. Conversely, if you have a very low threshold of risk, you may be directed towards fixed income. But most people will find themselves somewhere in the middle. The exact mix will depend on your unique circumstances. Many will also have to make tweaks to their original plan. Are you investing too little to reach your goal in time? Then you may have to reduce the size of the goal or increase the time, or even look to step up your investments. Likewise, if you're able to reach your goal comfortably with some money to spare, you could consider upsizing your goal or use those excess funds elsewhere. But you'll only know this if you have spent time doing the planning. Once all the pieces of the puzzle are in place, you or your advisor can decide on the percentage allocation to each of these asset classes. Now, what will happen over time is that if any asset class outperforms or underperforms, then the percentage allocation to it in your portfolio is naturally going to change. So when you rebalance your portfolio, you will have to again bring all the asset classes to your pre-decided allocation. Let me explain this with an example. Suppose I have decided to give a 60% allocation to equities, 30% to debt, and 10% to gold when I design my portfolio. Now, 6 months later, there has been an equity rally, so my original 60% allocation in equity has gone up to 70%, and my 30% allocation in debt has now come down to 20%. So what I will have to do is sell 10% from my equity portion and buy 10% in the debt bucket. This will again realign my portfolio to its original plan. This act of sticking to the percentage allocation is called strategic asset allocation. Tactical asset allocation, on the other hand, has no fixed percentages allotted to any asset class. It's a more dynamic approach where an investor may choose to increase or decrease this exposure to a certain asset class based on the market conditions and the outlook. The purpose of such an approach may be to take advantage of varying opportunities which are presented at different points in time, all the time trying to improve the risk-adjusted return on the portfolio level. This approach is preferred by many seasoned investors who have the appetite to ride out storms along the way without getting perturbed. While the dynamic approach may change allocation as often as the investor desires, the strategic allocation too isn't constant throughout one's life. This too should be reviewed at different stages of life so that it can be realigned to changes like age, any change in risk appetite, alteration in your goals, and so on. In fact, rebalancing is required in both cases, whether you have chosen strategic or tactical approach to asset allocation. Many investors may also choose to mix the two approaches. use strategic asset allocation for their core portfolio, and a more tactical approach for their satellite portfolio. So, how often should this rebalancing be done then? Experts advise that you should give your portfolio a look over at least once a year. If you have chosen to temporarily deviate due to a tactical event, then you should go over your portfolio once the event is over. And finally, everyone should reevaluate their allocation once in 5 years to update for changing lifestyles and finances. But one should always remember that the ultimate objective of this is not just return maximization. Rather, the objective is to choose a mix of assets which can not just help you reach your goals, but do it in a way that you don't lose sleep at night. Where a lot of us go wrong is when we try to only chase high return assets without having the stomach to deal with the volatility that they bring. Remember to always look at your portfolio on an overall level. Don't judge asset returns individually. The composite return is what should matter to you. So how do you check if your asset allocation is optimal? Experts say that if you're able to beat inflation by a good margin on a total portfolio level, if you have liquidity to meet near-term needs, and you're not losing sleep worrying, then you're on the right track. But do remember not to give in to your behavioral impulses when markets are volatile and make portfolio changes in a hurry. The entire idea behind long-term wealth creation is to stay invested in your allocated asset classes in the proportion specified and only make changes when required.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.